The Fed is trapped and they have limited tools in their toolkit to control inflation while avoiding crashing the stock market. But how will gold and silver react to this? For answers to this, I'm chatting with Tavi Costa of Crescat Capital, who's my guest on this episode of Gold Core TV. And remember, if you want to see more interviews with industry experts and thought leaders in financial markets, subscribe to Gold Core TV and hit the notification bell now. And if you want to learn more about how you can buy, sell, and store physical gold and silver, log on to goldcore.com, your precious metal specialists. Tavi Costa, welcome to Gold Core TV.
Thanks for having me. Looking forward to this.
Now, I want to talk to you a bit about inflation and the position that the Fed are in at the moment. We've got inflation officially in the US at 5.3% is the last print from last month. Unofficially, we expect that it's an awful lot higher than that. The Fed are talking about tapering. We've seen bond yields go up a little bit over the last couple of days. They've kind of painted themselves into a corner. If they start to taper, there's a chance that they're going to upset the stock market and they become hostage to the stock market at this stage. If they don't, we are fueling that inflation further. Have they painted themselves into a corner? Are they stuck? Where do you see it at this moment in time?
I would say that the biggest two things that are really putting the Federal Reserve into a very difficult position has to do with the multiples of risky assets and on top of the leverage situation, especially coming from the government side. I think those two have really forced the Federal Reserve to continue to suppress rates to either justify high multiples of valuations of assets or just be able to service the debt. At the same time, what is interesting right now and why I think they're really trapped is because the policies or the set of policies in order to fix what it seems to be a deceleration of growth that we're starting to see coming from Asia, especially. Those set of policies in order to fix that problem will certainly add to the inflation thesis. So I think a lot of central banks across the globe are going to have to make this decision. I think China is going through that decision right now of either adding more liquidity and helping a lot of the domestic companies that are having issues because of the debt problems, or allowing the system to have a reckoning moment, which usually central banks fall back to the liquidity path, which feeds into a long-term inflationary problem. I think there's a lot of reasons to believe that we have inflation in the system today. And I call this, there's a lot of pillars of inflation, a lot of structural changes that we're seeing today that I think will be much more sustainable than the transitory narrative that we hear from those policymakers. So
what are those pillars then?
Good question. I think some of those pillars, well, let's start with the first one is what's happening with the fiscal agenda, which has to do with a transfer of wealth from the government to the people. There's a lot of ways to see this. I mean, if you look at the bottom 50% of the population today, net worth, you can see that their net worth have increased about at least about 20+%, which is the largest increase in history compared to global financial crisis, for instance, when we had a reckoning moment when they actually declined by about 80%. So clearly we're seeing policies, regardless if it is food stamps going up or any type of idea of canceling student debt. All those are forms of wealth transfer. The actual helicopter money policies we saw last year and carried on to this year as well. So all those are different ways of directly giving money to the population and increasing the debt amount in the government side. So the imbalances have not gotten better overall. They only have been relocated from the household side to now the government side. And so households have deleveraged, believe it or not, households factually, if you look at the data of assets versus liabilities of those, across the entire society of the U.S. has actually improved. But that's really because of this wealth transfer happening. And so the wealth transfer tends to, when you give money to the bottom 50%, they tend to spend. Obviously, that's also having an impact on inflation. And that's one pillar of inflation. I think that will continue because of the big inequality issues that we're seeing today. Let's talk about the second one. The second one has to do with the wages and salaries. I think that we saw a secular decline of wages and salaries since the 70s or end of the 70s. I think that we're about to see a shift there. There's a lot of reasons to believe that that's going to happen. One of them is that as cost of living begins to rise, we see the demand for wages to increase by workers. Going back to the 1919 Spanish flu, we saw that exactly happen, where one out of five workers at the time was actually engaged in a protest for labor improvements. And so I think we're going to see something similar here. It's already happening. McDonald's already paying $18 an hour. When I moved to the US, they're paying like $7.25. And so a lot of things have been shifting towards that direction. In Wall Street firms paying more, companies in general paying more. Even Amazon is being forced to pay more. Chipotle paying more. So everyone is having to be squeezed to pay more to their workers. The third pillar has to do with the monetary dilution, which I think that's inevitably what we're going to see for the following years, is this debt monetization, or using monetary tools in order to allow the government to spend big money. In other words, when you look at the fiscal agenda, it has so many fronts. We can get into that later too. And so I think that will continue. And the goal of the Federal Reserve at the end of the day will be to suppress rates, or to allow the government to not blow up with the amount of debt that we have. And so we'll have to figure this out as we go. If it's going to be yield curve control, if it's going to be another package of QE without yield curve control necessarily focus. And so there's a lot of ways to see this. And I think that we'll continue going forward. And why I believe tapering is not going to be sustainable. And then the next one, the final one, is the deglobalization issues we're seeing. I think that really adds to the table here. It's something that was a long-term trend, but it started with Donald Trump, and I think it's just at the beginning. I think we're going to see a lot more towards that. I think we're seeing countries trying to avoid having their businesses in places like China. I think that's going to happen more and more. A lot of companies already have businesses in China and are forced to have to deal with the regulations and the geopolitics of that. But I think more and more we're going to see companies avoiding that transition. And so what does it mean for the rest of the economy? Well, we're not going to be able to get that cheap labor anymore. Labor is going up in costs everywhere in the world. And so all those things are going to play out into, in my opinion, inflation. And the idea of tangible assets. Investors are forced to buy tangible assets when you have an alternative of investments, they yield less than inflation. I think that's the case here as well.
So you talked about a reckoning moment there, and the reckoning moment can either be internal or external. And what I mean by that is an external event like we had in 2008, but an internal event more caused by the actions of the Fed. So if we do see tapering, we could see the market react poorly to that, and a significant sell-off in stock markets in particular. We haven't had a decent correction in stock markets for a long time, except for that blip in March, April of 2020, the COVID-related ones. What do you think is more likely? Do you think it's more likely to be an external shock, or do you think it's more likely to be an internal shock caused by the actions of the Federal Reserve?
I think a lot about this, and usually historically we've seen the Federal Reserve being the one that triggers the issue. In other words, it's been like a vicious cycle since the beginning of the 90s or so, where we start seeing inflationary forces getting to the system. The Federal Reserve is forced to act on it. It creates a financial shock, immediately accompanied by either a reduction of interest rates or more money printing, or QE, whatever you want to call it, that then helps the market at some point, but then ends up feeding into this inflationary story for the long term. To your question, I think that we're now got to a level where central banks are very much aware of the tools that work in regards to helping the markets. And by saying work, I'm not saying the macro imbalances are getting fixed or inequality issues are getting fixed. I'm just saying from a perspective of helping equity markets to go up, that's all. And so I think that they have figured out some of the tools that help that. So what leads me to the conclusion of, is it possible to see a deflationary bust in the economy here from a shock that is domestically caused? I think it has to be through an exogenous shock. And that's why I focus so much on China, because I do think that China has that capability, or the Chinese imbalances have that capability of becoming contagious globally and creating issues. Usually when you have a country that leads to a banking assets of about 314% relative to its GDP on a closed account economy, clearly there's something wrong in regards to the growth of credit in that economy relative to the economic activity. So I think that there's a risk that could be much bigger than an independent company such as Alibaba losing $400 billion of market value, or just Evergrande defaulting on their debt or not. And I think those are all symptoms of a much bigger problem happening in China. And so this deceleration of growth we're seeing really from China. I mean, if you look at the year-over-year change of asset prices from China relative to macro data in the US, you can see that emerging markets in China specifically have led a lot of the issues here in the US. And so, from PMI numbers, manufacturing, non-manufacturing. So that leads you to the conclusion as well that we're seeing a deceleration of growth as inflation stays actually pretty high or relative to history. And so I'm worried that an exogenous shock is what causes this reckoning moment, if we're going to see one. Now, domestically, market goes down 20%, 25%. I mean, what do you think the Fed is going to do? They're, probably going to do exactly what they did in March, but in, a 2x package. And so of stimulus. So this is why I think tangible assets will perform better than especially financial assets as a whole going forward, especially for this next 5 to 10 years. And so this is a secular trend that I'm trying to be involved with.
And as you say there, if we see a 25% correction in stock markets, you can almost guarantee that tapering's off the table, and there's an increase in bond purchases. Now, the tapering narrative has increased of late, but still, bar a small retracement in the stock markets, they're still looking pretty strong. Does that suggest to you that the stock market isn't really taking this tapering narrative very seriously, and also that the Fed are reduced to trying to jawbone the market to where it is rather than actually acting? So it's more a case of pay attention to what I say rather than what I do from the Fed, and then stock markets at this moment in time saying, we don't really believe you.
Yeah, I think it has to do with yields, not so much equity markets. First of all, if you look at the euro-dollar curve, that will tell you basically what the market is expecting in regards to how hawkish or dovish the market or the Federal Reserve is going to be along the years. You can see that it is priced in already a significant hawkishness for the next year or so. In fact, more than any other time in the last 6 to 12 months. So that trend line of steepness of the euro-dollar curve is clearly telling you that the market is pricing in that the Fed is going to go ahead with the taper. And that's why when I saw that chart, I was very much in line that I think the Fed is going to try to go that route, regardless if it's going to work or not. To your other question about why the equity market is not necessarily responding to this, I think it's going to fall back into yields. What would actually lead to a sell-off in equity markets is going to have to be probably some sort of higher cost of capital or the removal of any of the justifications to have those very extreme multiples. What are some of those? I think one of them is inflation getting out of hand. The other one would be 10-year yields moving a lot higher than where they are right now. And we saw the shock yesterday was probably caused by 10-year yields. And so I think that as the Federal Reserve becomes less of a buyer relative to the overall pie of treasuries outstanding, I think that that's going to have an impact of because supply is not going to change. The supply picture of treasuries is actually pretty strong. I mean, there's so many, as I said, there's a lot of fiscal agenda has a lot of main fronts right now. And I think that that's going to basically continue to have a very large spending in the government side for the next years or so. And so that clearly shows you that we're going to have large amounts of issuances of debt at the same time as the Fed is reducing their purchases. And we know that globally, a lot of countries are not buying treasuries as much as they used to in the past. And so who is going to be the buyer of last resort? And can the Fed really sustainably taper and get out of this position and allowing 10-year yields to rise? I think the Fed is basically running a live experiment. They're allowing the 10-year yields to do what they should do in a normal market, not manipulate it, and see what the impact is going to be with stocks. And if the impact is negative, then they're going to have to go back to those policies. So it's kind of like the question, if you were in a position where you were trapped, you would take any opportunity you had to get out of that position. And I think that's what the Fed is trying to do. Now, is that going to be successful is the question investors should be asking. If you don't believe it will be successful, you want to be buying any pullback in tangible assets. And so that's essentially what we're doing as a fund.
And since you talk about tangible assets, then we've seen precious metals in particular, which our community has a very strong interest in, and they have had a fairly muted time over the last couple of months. Silver back down in the low 20s, gold in the 1700s. Given everything that we have seen over the last number of years in terms of excessive money printing, we would expect gold and silver to be a lot higher. Why have they been reacting the way that they have of late, in your opinion?
That's the $1 trillion question, and there's so many ways to answer that question. I think, first of all, we saw gold reaching all-time highs, very similar to what we saw before the 2008 issue. And usually gold, at least the last time it did, surpass its prior highs in a large way, which was the 1970s when we saw that in 2008 or so. We clearly saw weakness after that. So, and during that time, gold prices reached new highs, and immediately the market just saw weakness for that period of time, and then until the market really got its consolidation period, and then went on to new highs after that. I think we're kind of in the same position right now with gold. Gold went up about 75% from 2018 all the way to 2020, and I'm talking about August 2018 to August 2020. And so we've been in this consolidation to downward trend since that period. And I think it's kind of in line with what we saw in 2008. Obviously, I didn't think this was going to happen. I actually thought gold prices would continue to go higher, at least for a little longer than that period. But looking back in history, that seems to be kind of the normal trend. The other thing I would point out is gold has really peaked in August of 2020, exactly at the time when 10-year yields begin to rise. And so, does it mean that if yields continue to rise, gold's going to get punished? Look, go back to the 70s and you saw 10-year yields rising the entire decade, and gold did just fine. So it doesn't have that much of a factor. Obviously, we now see the correlation of real rates being much bigger than nominal rates. The other thing I would point out is it has to do with the euro dollar, which has to do with the Fed tightening. I think gold has been pricing in that the Fed is going to try to go that route for some time now. And so I think that has to do with that as well. So it's a lot of things to unpack, but what would make you believe that gold is dead? That would make you believe that, all those hundreds of years of history that we've seen so far in regards to gold being money, and the use, especially, I think the most important part is not even that, is the use of gold as a central bank asset in order to increase the quality of international reserves. We were just talking about treasuries now. I think there's a secular trend about to start, which is going to be improvement of quality of those international reserves, and that has to do with, should we own treasuries or should we own tangible assets like gold and perhaps even silver? And will Bitcoin play a role into that? I think that's why gold will continue to be, playing that role of being that asset that improves quality of central bank assets as a whole. And so I think that's still to come, and that will create some of the demand for gold as it has in the past. And so I think that it's important to be, in my opinion, taking advantage of those pullbacks that we see, the miners trading at ridiculous multiples, as you guys know. And so it's been a tough ride recently, but if you're a long-term investor, I think this is as good as it gets. The narrative is untouched. At the same time as you still have very solid fundamentals for gold going ahead, with a very technical oversold market. And so I think it's time to be accumulating assets rather than doing the opposite.
Before we let you go, where can our viewers find out more about what it is that you do, and where is it you hang out on social media?
Two ways. Our website is Crescat.net. And if you want to find out some of the stuff, or you can find out a lot of stuff about on our website of what we do. There's a lot of letters, in-depth letters that we write about the macro environment, a lot of interviews, and so forth. And we do a weekly presentation about mining companies that we get involved with, Quinton Henney. You can find that on YouTube if you just type Crescat or Tavi Costa. Now, if you want to find me on Twitter, it's at Tavi Costa is the handle. And I usually post stuff almost daily there.
Fantastic. What I'm going to do is I'm going to put a link to the website and your Twitter handle in the show notes below this video. But for now, Tavi Costa, thanks for joining us on Goldcore TV.
Thanks for having me.
Thanks for watching. And if you enjoyed this video, you're bound to enjoy these interviews with other thought leaders in financial markets. But remember, if you want to see more interviews with thought leaders and financial experts in financial markets, subscribe to Goldcore TV and hit the notification bell now. And if you want to learn more about how you can buy, sell, or store physical gold and silver, log on to goldcore.com, your precious metals expert.